Hi there, Chaz Rupra here from High Clarity Accountants, and in this video I'm going to be showing you how it might be time to reconsider your company car strategy. I'm going to cover the tax implications of having a company car, recent changes and developments that have taken place, and how this might benefit you going forward. When you have a car registered to the company and some personal use, this gives rise to something called benefit in kind. These are taxed in order for you to stop replacing salary with other benefits. And for company cars, they are taxed by a mixture of the list price and the CO2 emissions. Now to demonstrate, let's take the example of a petrol or diesel car with a list price of £50,000. Now remember, even if you bought this second hand, you still have to go by the brand new list price of the car. Now if it's anything half decent, it's probably got a CO2 percentage of 37%. And if you get the company to buy the fuel, then you're going to be liable to something called a fuel benefit. On the assumption that you're a high rate taxpayer, then you're likely to pay about £11,000 of personal tax each year. On top of that, your employer, which is your limited company, is going to be subject to employer's national insurance, and that's going to be about £2,500. Yes, you can reclaim some of the corporation tax, but in this particular example, that's going to be limited to only 6%. Now, if you opt to lease the car, then the situation is somewhat better, but you still will be stuck with those personal benefit in kind taxes. Because of these heavy benefit in kind taxes, the advice was always to claim MAPs, so mileage allowance payments, where you get 45p per mile for the first 10,000 miles and 25p thereafter. The strategy was to keep the car outside of the company and then charge the company back for any mileage that you did in your personal car for business purposes. Now in recent years there has of course been a drive towards green energy, and the government has been giving tax incentives to encourage this. Electric vehicles have also had tax incentives for a while. However, the choice that you have of the different cars you could have bought and the actual range they achieved between charges wasn't that great, which put a lot of people off. The good news is manufacturers have now brought out a whole range of very desirable vehicles, and the range they can do before recharges are much more practical. Okay, so this time let's take the example of the electric car and what impact that has on taxes. So in this example, a £50,000 purchase or £50,000 list price only gives a benefit percentage of 1%, as opposed to the 37% for the petrol or diesel car. Now this has gone up slightly from 0%, which it was last year. Nevertheless, it still only means that the benefit that you're assessed on each year is £500. There's obviously no fuel benefit because you'll just be charging the car at home, which in turn means that each year all you'll be liable to is £200 of income tax each year as a high rate taxpayer. Employer NI will also be much lower, as it's based on the lower percentage, so it's only £69, and in addition you'll be able to claim 100% first year allowance for the purchase price of that vehicle, which means you can get £9,500 corporation tax deduction. So in summary, you'll see from the table there the net benefit of an electric vehicle is about £9,300, whereas there is a net cost for the petrol or diesel vehicle of over £10,000. So next time you're in the market for a car, it might be worth considering electric. If you found this video useful, then you might also be interested in our taxability checklist. It's 70 tax planning strategies covering business, personal, capital gains and inheritance tax, all in a checklist format. To get your free copy, all you have to do is click on the link below.